Okay. We'll do batteries in my remote and hoping that that would help solve my technical issues. Make a difference. Okay. So long-term assets. We know what assets are, right? Assets are things that we own as a company. The long-term assets are things that we own that we expect to own for a long time. Right? As opposed to current assets that we expect to use up or that we could possibly turn into cash in a shorter period of time. So long-term assets are expected to last more than a year. So there are different varieties of long-term assets. As it says here, some are tangible, some are intangible. And by intangible, specifically in accounting, we mostly mean intellectual property. Things like trademarks, copyrights, and patents would fall into that category of intangible. So we'll learn more about that a little later. Now, some long-term assets we need to capitalize. And that doesn't mean capitalize the first letter. What it means is treat it like capital. God bless you. Thank you. Which means that for a lot of long-term assets, the cost of that asset we cannot count as an expense all at one time. The IRS requires that we spread out the cost of that asset over years. And that's what depreciation is. Taking that cost, that asset, turning it into an expense that we take little by little, year after year, and that's depreciation. There are other long-term assets where we do not capitalize them, we do not depreciate them, we can count them as an expense. So we'll learn what is the difference between the two. We'll learn the different depreciation methods. As I mentioned, the main options for depreciation are straight line, which is pretty simple, units of production, which is also pretty simple, and then the double declining balance method, which is a little trickier, but not that bad. We'll learn how to depreciate intangible assets. Technically, we don't even call it depreciation with intangible assets, but we'll get to that later. And special issues in accounting for long-term assets. It's hard for me to say for some reason. So that's what we're going to cover this week. All right. So again, we know what long-term assets are, right? As it says here, long-term assets are not intended for resale. Inventory is something you plan to sell, right? Or plan to turn into a product that you can sell. But things like equipment, unless you're in the equipment business and that's what you sell, you use equipment in order to run your business. And so you don't plan to sell it until maybe you decide to upgrade your equipment and get rid of the old equipment. So in that case, yes, you can sell that old equipment. You could sell an old building or vehicle you don't need anymore, but that's not really what your business is all about, right? That's just getting rid of some long-term assets. And then when you sell those assets that were not your product, you either have a gain or a loss, which is something we started talking about at the very beginning of the course, because those go on the income statement, remember? Just like revenue and expenses, if you have gains and losses from selling long-term assets, you would include those on your income statement. Now, how do you figure out, let's say you sell a piece of equipment that you don't need anymore, how do you figure out if you had a gain or you had a loss? Does anybody remember what the difference is? It's based on the book value of the asset. You remember the cost concept, that told us that when you buy an asset, you record it in your books at whatever that cost was. And then it doesn't matter if that asset has now gotten old and now it's not worth as much. It still shows that original cost. So the way we devalue an asset over time is depreciation. So if you take the original cost of the asset minus however much it's depreciated, that gives you the book value. Okay, so cost minus the depreciation is the book value. And then if you sell the asset for more than the book value, that's a gain. If you sell it for less than the book value, that's a loss. And that's a big part of why we have to do this. But the other big part is that, remember, expenses reduce your income tax liability, right? So when companies can depreciate their assets and count that as a depreciation expense, that saves them some money on their taxes. All right. So as I mentioned, something like equipment, unless you're in the equipment business, it's just something you use to operate your business and to make your business profitable, right? Maybe it's a copy machine you use because you have to make copies to distribute information to your employees. Maybe it's a lathe that you use to shape wood into a certain shape to make your products. Whatever your long-term assets are, if they help you operate your business, somehow generate some revenue, then you can take that asset, you can depreciate it over time, but you can't take the cost as an expense all at one time. You have to depreciate. So obviously some assets are tangible, right? What does tangible mean? What's meant by the word tangible? You touch it, right? Something physical. Intangible, as I mentioned earlier, what we really mean by that is intellectual property. Ideas. Things like a copyright. You write some text, if you write some music, that's your idea that you came up with, right? And one way you can protect yourself legally is you register that you wrote that. You've now copyrighted, not copywritten, that's a common mistake. You've copyrighted that material, and that registers and records that you are the original author. And if other people copy it without your permission, because you are the one with the right to copy it, they have to get permission. If they don't have your permission and they copy your work, you can sue them, right? So it's really an idea that you have documented. Same thing with a trademark. If you come up with a logo or a name for your product, you can protect it legally through a trademark. If you come up with some very successful business and you decide to franchise so that other people can use your business idea and your business name, you've created a franchise. That's another form of intellectual property. It's another intangible asset. Well, these intangible assets that I've mentioned, they have value too, even though they're not physical, and even though they're really just ideas that have been protected legally, they have value. And we can take that cost of that asset and spread it out over time, or the value of that asset, we spread it out over time as an expense. So we'll learn how to do that. All right. Any questions so far? Okay, so one category of these long-term assets is property, plant, and equipment. Now, these would be physical, tangible assets. And they include property, things like real estate, plants, not plants like trees, but plants like factories. Anything related to your factory would be part of the plant. And equipment. That is one category, right? Because especially if you're a manufacturing company, that's stuff you really need to be able to make your product. You need to have a warehouse, factory, equipment, all that kind of stuff. And so we make that one category of these long-term assets. So we see for this company, and this is in millions, by the way, so they had $10 billion of land and buildings and went up to $13.5 billion. And they have machinery, equipment, and software. That's interesting. Now, software is not tangible, right? You can't touch software. You can maybe touch a CD that has software on it, but the software itself is just a computer code. So you might think that that would be an intangible asset, but it's not. Remember, the intangible, according to accounting, intangible assets are really the intellectual property that we just talked about. Copyrights, trademarks, patents would fall into that category. Something else we'll get to later called goodwill. Those are intangible assets. Software is part of your property, plant, and equipment. It just is, okay? If you wrote the software and you had a copyright on the software, now it's an intangible asset. But if you just buy the software from somebody else, it's part of your property, plant, and equipment. By the way, you can, for short, say PP&E, or maybe even just PPE. So if you hear that term PPE, in this case, it's not talking about the personal protective equipment that we all wore during the pandemic, right? That was also PPE. This is PPE in relation to accounting, property, plant, and equipment. Now this particular company also had some leasehold improvements. Anybody know what that is, a leasehold improvement? If you're a tenant, meaning you're renting something, some building, and you make some improvements to that building, like maybe you add some internal walls, or you put in a bathroom or something like that, with the landlord's approval, because you don't want to do it without their approval, that's a cost to you. And even though you don't own the building, you can count that improvement that you put in there as an asset. So that's what this refers to. So they add up all of their PP&E, but then look at this, accumulated depreciation. Don't worry about amortization yet, we'll get to that later. Accumulated depreciation. Do you remember earlier I said the way we find the book value of an asset is you take the original cost and you subtract the depreciation. And that's what they're doing here. They're saying, okay, we've got $75 billion of PP&E, but we've taken $41 billion of depreciation on that PP&E. So the book value is the difference. Cost minus the depreciation is your book value. So if this company sold all of their PP&E, you might think, why would they ever do that? Well, maybe they're going out of business. So they sell all of their PP&E. If they sell it for more than this amount, they have a gain. They have to pay tax on that gain. If they sell it for less than that amount, they have a loss. And that actually reduces their income tax liability. Any questions or comments? PP&E, depreciation, long-term assets. Okay. All right, here we see a balance sheet for Apple. I don't know if this is, it looks like this might be their actual data. Interesting, okay. So it's actual Apple data in millions. And the first category of assets on the balance sheet is the current assets. And we know those are assets that you're likely to either use up or sell, or at least you could sell within what period of time? Current assets. A year. And technically, it could also be within one operating cycle, but let's just say a year. So that's one whole category, current assets. But then we get down to the long-term assets. And I've mentioned to you there are multiple types. So one type of long-term asset would be investments, long-term investments. Actually, I think, yeah, we have some short-term investments here. So Apple had some short-term investments that it's planning to sell within, God bless you, within a year or an operating cycle. So it lists those under the current assets. But they've got other investments that they're not planning to sell within a year or operating cycle. And so those are long-term. So your investments could be stock, could be bonds, could be real estate, anything that you purchase as an investment is either going to fall into the short-term investment category or long-term, depending on when you plan to sell it. Then they have their PP&E category. Then they have goodwill, that we'll get to later. Not the thrift store, it's a different goodwill. And intangible assets that they have purchased. If they buy an app, if they buy software, if they buy a patent, those are intangible assets that they have acquired. And then they've got some other long-term assets that didn't fit into any of those categories, so they just put it in other non-current assets. So now if you take the current assets, plus all of these different types of long-term assets, you get the company's total assets. Why go through all these steps? As an investor, why would you want to see it broken down like this? How does it help you?
You see how to make it as money.
Okay, yeah, so we know that here Apple has 375, this is as of 2017, $375 billion worth of assets. They own a lot of stuff, right? And $128 billion of those assets are just current. It's stuff that they purchased, but they're not gonna have it that long. If they took out any debt to pay for these short-term assets, it would have been short-term debt. These other long-term assets, they're going to have for a long time, right? So you can expect those to be very stable. The short-term assets might go up and down quite a bit every year. But they're probably not going to be selling off these long-term assets. So those will stay pretty similar. They might be growing as the company grows. They might sell some of them off. But what you know in this case, it's kind of like if you think about yourself as an individual, instead of thinking about Apple. You probably own stuff like clothing that gets worn out, you know. What else? You might have put gas in your car, it's probably going to get used up within a year. You might have some food in the fridge, it's not going to last too long. So those are your short-term assets. On the other hand, if you do have a car, hopefully it's going to last longer than a year, right? It's a longer-term asset. So those long-term assets really contribute to your overall financial foundation. If you have a house, it's a long-term asset. It's probably going to keep its value, and you might even see its value go up over time. Listen.
What would you consider a lease?
A lease, it's an expense.
But it wouldn't be considered long term, right?
Well, usually leases are for a year or less, except in commercial leases, they could be multi-years, but they are not an asset themselves. If you've prepaid for the lease, that is an asset, right? I think we've covered that in the previous chapter, but the lease itself isn't, because you don't own it, right? or the landlord, they've got the asset, that's the property. Good question. All right, okay, any other questions? All right, let's go on here. Let's see. Okay, the value of intangible assets is very subjective. So let's think about it. Let's say you've written a song and you copyright that song so that if anybody samples your song and uses it or cuts their own version of your song, they have to pay you some money because legally you could sue them otherwise. But what is that song worth? How do you know? Might not be worth anything. It might be worth millions of dollars. And that's what this is saying. When a company creates a new product, maybe they patent that product, or they come up with a new logo, who knows what it's really worth? If Nike came to you and said, we want to give you our Nike swoosh, you now own that. You have control over who can use it, and we can't even use it unless we pay you money. That would be worth a lot, right? That Nike swoosh. But when it was first created, in fact, if you took my intro to business class, you might have seen a video that I show that talks about the history of that design. It was a student who came up with the Nike swoosh, and Nike paid her something like $35 for her design. And it's probably worth millions, if not billions of dollars, because it's such a recognizable brand. So when you create an intangible asset, how do you really know what it's worth? You don't. Mostly in this chapter, in the exercises and problems, when we're dealing with these intangible assets, it says we bought it from somebody. Because when you buy it, then you can figure out what it's worth. It's what you're willing to pay and they're willing to sell it for, right? That's then the value. But until it's been sold, who's to say what it's really worth? So let's see. Again, patents are when you invent a product or a process, and then you register that to prove that you came up with that product or process. It says here they have a life of 20 years. I think there are exceptions. I think it depends on what type of product you have. So I wouldn't rely too much on these legal estimates of how long they last. Then we have copyrights. It says that lasts for the life of the author plus 70 years. So basically, you wrote that song, and then at some point in the future, you pass on. I mean, I guess we all do eventually, right? And then your grandkids become the inheritors of that copyright. It lasts for 70 years longer. And then after that, it becomes public domain, where anybody could record that song and not have to pay royalties. And then we got trademarks. If you invent a logo or a product name, it says it has a 10-year lifetime legally, and then you can renew it for 10 years at a time. So those are some examples of intangible assets. Right? Questions, comments? Oh, why is it that we don't consider employees assets? Might have discussed this before, but remind me, why don't we count employees as assets?
You don't own them.
Because you don't own them, right? Despite the fact that some companies will refer to their employees as assets, technically from an accounting standpoint, no, they're not assets. All right. So here it does tell us, this is one of the few places in the whole course where IFRS comes up, which you might remember was an alternative to GAAP. GAAP, quiz time. What does GAAP stand for? Generally accepted accounting principles. Thank you, Daniela. Correct, right? And that's what most of this class is based on, because that's what most American companies utilize. In fact, you have to, unless your business is international and does a lot of international business, you might use the International Financial Reporting Standards, IFRS. So here is the difference. How you count the expenses associated with developing an intangible assets. As it says here with IFRS, when you do research to come up with a new product, that you consider an expense. However, the development of that product, you can actually capitalize so you can spread it out over multiple years. Interesting. Research and development, they go hand in hand, but they are two different things. Research, maybe look at what product do our customers want? How much are they willing to pay? That would be research. But then when you're actually developing the product, the costs associated with that would be treated differently under IFRS. However, under GAAP, both the research and development costs are considered expenses. So let's think about this. You're developing a new product. Maybe you're writing that song. That would be development. But you don't know what that song's going to be, right? You don't know how much it's going to really be worth. So it makes sense that any costs associated with developing that song, you have to treat them like an expense. Because in order to capitalize it and spread the cost over multiple years, you have to know what that value is. So instead, you just, any expenses related, maybe you're paying a market research firm to go out and find out what music people want to hear. Maybe you're hiring, I don't know, Jay-Z to come in and rap a little bit on your song. That would be part of the development cost. Treat that as an expense. But if you bought a song from somebody else, not an expense. In that case, you then have to spread that cost out. You have to capitalize it and spread it out over multiple years. Questions or comments? All right. Oh, so let's look at these assets, the bullet points, and think which of these would be classified as intangible assets. Now, there are some on here that you can't touch, so you could say that they're intangible, but what we mean from an accounting standpoint, again, is intellectual property, ideas that you can protect legally. Okay, so which, and I'll just tell you there are two of them. Let's find the two examples of intangible assets out of this list. Let's just go through it. Cash. Seems intangible. I mean, you could touch physical cash, but money in your bank account, you don't physically touch it. It's just a number on a screen. So in a sense, it's intangible, but it's not what we mean by intangible assets. In fact, it's not even a long-term asset. Typically, it's considered short-term because you can spend it any time. What about a patent? Does that be classified as an intangible asset?
Yes.
Yes, it would. Okay. And again, patents are when you develop a product or a process and you register that idea with the US Patent and Trade Office. That's who you would contact. And it's not cheap to do it. You probably want to work with a patent attorney that can help you make sure you're doing it right. Make sure somebody else doesn't already have a patent on a similar idea that you could be violating their patent. And it's not a quick process either. So it's expensive and time consuming. But if you have a product you invented and you don't want other people to to cheat you, to make your product and make money off of it without paying you anything, then you better patent it. Not only that, imagine you come up with this amazing product. Maybe it cures all cancer, right? That'd be incredible. And you don't patent it because you say, oh, it's too much of a hassle. Well, somebody else could then patent your idea. They could sue you for using their patent, right? So you kind of have to just to protect yourself. So yes, this would be what we call an intangible asset. Accounts receivable, you could say it's intangible, but it's not what we mean. What is accounts receivable? I hope you know by now. What is accounts receivable? Anybody? This is accounting, right?
What do you receive?
Yes, money we're going to receive from our customers. Land. Land is definitely tangible. You can touch land. Investments. As I mentioned, we have a category for short-term investments. We have another category for long-term investments. So they're not what we mean by intangible. I also mentioned software. If you invented the software and copyrighted it, then that copyright would be an intangible asset. And actually, we see copyrights right over there. So that is the other one. Patents and copyrights. Everything else listed here is not an intangible asset under the accounting definition. In fact, some of them, like accounts payable, aren't even assets, right? It's a liability. Owner capital, that's equity. So we really only have two examples out of these bullet points, unless I'm missing anything. Patents and copyrights. All right. Okay. So I mentioned that when we capitalize an asset, we're taking this long-term asset, we're taking the costs involved with it, and we're spreading those costs over a number of years. That process is called capitalization because those long-term assets themselves are considered capital. There's something that are used to make a profit. Equipment, buildings, vehicles, patents, all of these are things that are part of our business. And we need them to make a profit. So we capitalize them over a number of years. Like PP&E. So the way we do that is depreciation. That's how we capitalize and spread that cost over multiple years. Because again, that's what the IRS requires. If the IRS let us take the entire cost, then let's say a company goes out and they buy a $10 million building. And they can write that all off their taxes at one time. Their tax liability is going to go super low. In fact, they might even end up getting a tax refund because of that huge write-off. But the IRS says, no, you can't do that. You got to take that $10 million building that you just purchased, spread that cost over maybe 30 years, and take that expense a little bit at a time. And we call that depreciation. Now let's say we bought a building to use as a factory. So that's PP&E. But what if we bought another building that we're not going to use at all? We just bought it because we think it's going to be worth more in the future. So we buy the building, we don't do anything with it, and then we plan to sell it next year. In that case, that building is an investment, not PP&E. So it would fall under the category of long-term investment. As we discussed earlier, investments could be short-term or long-term. Let's say we have to do some work on a tractor. Would a tractor be PP&E, property, plant, and equipment? Yes, it would. Okay. Well, if the work we're doing is just routine maintenance, just getting the thing working again, you know, changing a battery, I guess, I assume tractors have batteries. Replacing a tire, changing the oil, something like that, that's routine maintenance, that's an expense. We can go ahead and just count that expense in this period. We don't have to depreciate. But let's say we do some work on the tractor that's going to extend the life of the tractor. We completely replace the engine. Now, this tractor that kept breaking down is going to last us another 10 years. Well, the cost of replacing the engine, because we've increased the value of the asset, we can go ahead and capitalize that over a number of years. So when we're making repairs, if it's routine, it's an expense. If it's a major repair that increases the value of the asset, then we have to depreciate it. As it says here, if it increases the life of the asset, the capacity, so maybe a tractor that before could, I don't know, cover an acre an hour, now it can do 2 acres in an hour. So that increases the capacity of the asset. Improves the quality of the asset. In those cases where the value of the asset is going up, we capitalize those costs. As opposed to routine maintenance, where the cost is an expense. Okay, so here's an opportunity to test our knowledge. Would we classify these costs as capitalized or expensed? Also know which ones are property, plant, and equipment. Let's go through this together. Expenses, normal repair and maintenance. I just mentioned, we treat that as an expense, right? Taxes on new equipment used in business operations. Okay. Taxes are part of the original cost. Never told you that before. But when we record the cost of an asset, it's not just the price. It includes shipping costs, taxes, any costs associated with getting that asset up and running. All of that is part of the original cost. So all of that goes into the capitalization. So new equipment, which obviously is PP&E, the taxes that we paid on it at the time we purchased it would get factored into that depreciation. Same thing with shipping costs. However, minor repairs, again, are an expense. So we don't depreciate that. Land next to the production facility where we're planning to build a warehouse. That's PP&E. It's not a warehouse yet, but that's what the intention is. So that land is PP&E. Now, actually, though, this is one of those exceptions you just have to remember, we don't depreciate land. If you think about a building, buildings over time deteriorate. Even like, you know, the Roman Colosseum lasted for thousands of years, but it's you know, slowly falling apart. Physical things do that, right? It goes back to one of Newton's laws. Things tend to fall apart. So physical assets deteriorate over time, and that's part of why we're allowed to depreciate them, because we expect that they're going to lose their value. Now, the market value might go up, but that's a different thing. We're talking about the actual physical structure, whether it's a car, whether it's a building, they do deteriorate and they lose their value. So we can depreciate them. But land is always land, right? You could have a fire or an earthquake or a flood. It might change the land, but it's still going to be land. So we don't take depreciation on land. Buildings on the land, you can depreciate. Land itself, no. However, as far as whether or not it would be PP&E, again, if we're planning to use that land to put a warehouse, that would be PP&E. If we bought the land only because we're going to sell it in the future and we're not planning to use it as part of our business, then it's an investment. So it would go into a different category on the balance sheet. And then equipment obviously is PP&E, and it would get depreciated. All right, questions? Okay, an exercise. Number 2. So have you all solved this one? Again, we have accounting stuff videos on depreciation. So if you get confused or just want some extra clarification on some of these concepts, you might want to check out those accounting stuff videos. So let me first point out for tangible assets like PP&E, we use depreciation. For natural resources, if you own a forest, if you own a mine, something like that, something that's part of Earth, and you're using those resources, we don't call it depreciation. As you use those resources, we call it depletion. It's not that difficult to calculate. We'll get into that a little bit later, but just keep in mind that's what depletion is. It's like depreciation, but it's for natural resources. And then for intangible assets, again, we don't depreciate, we amortize. And it's similar to depreciation, but we use the term amortization. Let's start off with depreciation. We have 3 basic methods. Straight line, which is just based on a period of time. Units of production, where you depreciate based on how much you use the asset. And the double declining balance method, which is, as I mentioned earlier, it's a little trickier, but you would use this if you want a bigger tax write-off in the first couple years. This will help you achieve that. Okay, and then we'll get into how to do depletion and amortization later on. So the first thing, before you can depreciate, you need to know what is the cost of the asset. And as I mentioned to you, it's not just the price that you paid, right? It's also the shipping costs, the taxes, anything associated with setting up the asset. Like maybe you needed somebody to put it together for you, to calibrate it, if it's a machine, to make sure that it's set properly, so it's running at the right speed. You know, that would be calibration. Anything related to installing that asset to make it functional. Those costs all become part of the overall cost of the asset. So we need to start there. Because unless we know the total cost, we don't know what to depreciate. Let's see. Oh, this is just a journal entry. Okay. So this is showing that this person bought some equipment for his business. Okay. The equipment cost $5,000. So that's what he records in his journal entry. He debits his equipment account, $5,000. That was the total cost of that asset. He paid part of it in cash, part of it he signed a note. Again, doesn't matter in terms of depreciation, how you paid for it, not relevant. But of course, for your journal entry, it is. You have to record cash and any other form of payment. So pretty simple journal entry. Here's how you figure out how much depreciation you could take. And this is just really the basics. The IRS has all these sophisticated ways of figuring out depreciation that I don't know anything about. I would say if you go into tax accounting, you'll learn about many other types of depreciation. But we're going to keep it simple here. So, first of all, you need to know some terminology. You know what book value is, right? The cost of the asset minus any depreciation you've already taken is your book value. What do you think would be the lowest your book value could be? If you bought an asset for $1,000 and you kept taking depreciation every year, what would be the absolute lowest book value you could have? Zero. You can take, if it's $1,000 asset, you can take $1,000 of depreciation over time until you get to zero, right? At that point, the book value is zero. So if you've got a fully depreciated asset with a book value of zero and you sell it, whatever you sell it for is going to be a gain. However, let's say you'd only depreciated it by $300. So that $1,000 asset now has a book value of $700. And you sell it for $750. Your gain is just $50. Just the difference between the book value and the sales price. So that's how book value works. The useful life is how long you plan to use the asset. That is part of the depreciation calculation. How long you as a company are planning to use the asset. Then we get salvage value, or also called residual value. If you think that when you're done with this asset, you're going to be able to sell it to somebody else. So let's say we bought that equipment for $1,000. We're planning to use it for a couple of years and then sell it for $200. That $200 we expect to get for it in the future, that is our salvage value. So we don't depreciate that amount. Why would we depreciate it? If we depreciate that asset all the way down to zero and then sell it for $200, now we're going to get taxed on the gain. So if we expect to sell it for $200, we're only going to depreciate it down to the salvage value. And then if we do sell it for $200, there's no gain and no tax. Then there's the depreciable base. This is the book value minus the salvage value. So whatever the asset is worth on our books, minus whatever we are expecting to sell it for, that is the basis for which we calculate how much depreciation to take. Here's an example. We bought a truck for $10,000. Okay. Now, since we just bought it, the book value is $10,000. We haven't taken any depreciation. And to figure out how much depreciation we can take every year, we first have to figure out our depreciable base. So we take the original cost minus the salvage value, because we're expecting we can sell this truck for $1,000 in the future. So the difference would be $9,000. That is our depreciable base. That's what we're going to use to calculate how much depreciation to take every year. And if we planned it out perfectly, we take that depreciation every year and then get that asset down to a $1,000 book value, we sell it for $1,000, no income tax liability, okay? So your depreciable base, the original book value minus the salvage value. And that's pretty much all you need to know here. When you calculate your annual depreciation, and then you journalize at the end of the year to show how much depreciation you took, you're going to put depreciation expense as a debit, because we know, taking you back to the DEAL acronym, expenses are part of DEAL, right? Who remembers DEAL? You get bonus gold stars if you remember DEAL. What does DEAL stand for? Okay, too slow. Dividends, expenses, assets, and losses, right? Okay. I gave you a chance. Dividends, expenses, assets, and losses. So expenses increase on the debit side, right? So we have an expense, even a depreciation expense. We record it with the debit. Now, we also have to credit something, right? We credit accumulated depreciation. And that is where we keep track of how much depreciation we've taken for that particular asset. So let's say we bought that $1,000 piece of equipment and we're taking $100 of depreciation every year. Every year, we would record $100 depreciation expense as a debit and $100 accumulated depreciation as a credit. So if we go to the accumulated depreciation account in the ledger for that particular piece of equipment, we would see first year, $100. Second year went up by another $100. Now we're at $200, right? Next year, it goes up by another 100. So now we're at $300. And we would keep accumulating depreciation until we reach that depreciable base. And then we're done. So what type of account is this accumulated depreciation? As it says here, it's a contra asset account. So it's an asset type of account. But remember, assets are part of DEAL also, right? When assets increase, we debit them. Because this is a contra asset account, contra means like opposite or against. This is a type of asset account that increases on the credit side. And the reason it increases on the credit side is because it's reducing the value of the asset, right? If we looked at the equipment account, which would be an asset, saw $1,000 because that's what we paid for it. And then we looked at the accumulated depreciation, God bless you. We looked at the accumulated depreciation account and saw we had taken $100 of depreciation on that equipment. And like I told you, the book value would be the original cost, $1,000 asset, minus the $100 accumulated depreciation, the contra asset that reduces book value, right? Are there any questions? Okay. Oh, we see it right here. So here we've got a truck. We paid $25,000 total for that truck. That's the historical cost. That's what, if you looked in the truck account in the ledger, it says $25,000. But we've taken $5,000 of depreciation. That's how much has accumulated over the time we've had the truck. So the book value, again, original cost minus the accumulated depreciation, the contra asset, and that gets us to the book value. All right, what is the depreciable base here? Okay, so here we've got an asset that costs $54,000. It costs us $1,500 to get it shipped to us. Another $2,500 to get that asset set up and functional. And again, we can add all of that together, including taxes, if there were any taxes. And that is the total cost of the asset. Now, if we think that at a certain point in time, we're going to sell that asset and we're going to get $10,000, even though that's just an estimate, that is our salvage value, right? We're going to salvage that much out of this asset by selling it. So we don't want to depreciate that salvage value, because then again, if we do that, we're just going to have to pay taxes on that amount. So we subtract that salvage value from the total cost. That gives us our depreciable base. That means we're planning to take $48,000 of depreciation on this asset. When we take that $48,000 and we use one of our methods to spread that out over time. So the easy way, the first way to do that is straight line depreciation. We would just take that $48,000, the historical cost of the asset minus the salvage value, and divide it by how many years we expect to use the asset. And that tells us how much depreciation we can take every year. So it comes out to $9,600 in this case. Okay, great. So at the end of the first year, we take depreciation. We record that as a depreciation expense on this printing press, $9,600. That reduces our tax liability. And we also say, okay, so far we've accumulated $9,600 of depreciation. Now, if we wanted to figure out the book value for this particular asset, we would take the original cost minus the accumulated depreciation to get our book value. Then another year goes by. We take another $9,600 of depreciation, right? So now how much have we accumulated? Well, 2 years worth of depreciation, right? And 2 years worth means we've accumulated a total of $19,200 of depreciation between years 1 and 2. So now when we take the book value minus the accumulated depreciation, we get our new book value. So every year that book value just keeps going down as we take more depreciation, until we get to the salvage value, which is how much we're planning to sell it for. Let's say we changed our mind and decided not to sell the equipment. We're just going to keep taking depreciation. We can keep depreciating it till we get to 0, till it has a book value of 0, but that's it. Then you fully depreciated that asset. If you try to keep taking depreciation on it, the IRS is going to be like, I don't think so. We're going to audit your books because you can't do that. You can only depreciate the original cost at the most. So that's how we journalize depreciation. That's why we journalize depreciation. And that's how we calculate with straight line. Again, original cost minus the salvage value divided by the number of years you expect to use it. Any questions on straight line depreciation? All right. Then let's move on to units of production depreciation. In this case, instead of basing it on a period of time, you base it on how much you expect to use that asset. So in this case, it's still a printing press. Same original cost of $58,000, same salvage value of $10,000. But what's different is they're going to base depreciation on how many pages this printing press can print. And they expect that it can print 960,000 pages. So probably the manufacturer said, that's what we think you're going to get out of this printing press, and then it's going to fall apart. Okay, so then we take our depreciable base, the original cost minus salvage value gives us the depreciable base, divide it by the number of pages that we expect this thing will print. and it comes out to 5 cents per page. So now, the way we're going to figure out our depreciation expense is how many pages we print times 5 cents. So every year, we just take the total number of pages we printed, multiply that by 5 cents, and that's our depreciation expense. Now that means that in years where we're super busy, we're gonna have a bigger depreciation expense because we're printing more. And in years where we're slow, we'll have a lower depreciation expense. Why might that be an advantage? From an accounting standpoint, why might you want a bigger depreciation expense in your busy years and a smaller depreciation expense in your slower years? You're busier, you got more customers, more orders, you got more revenue coming in, right? With more revenue in, you want more expenses to help reduce your tax liability. On the other hand, when you're slow and you don't have as much revenue coming in, you don't need that tax write-off. So with this approach, it kind of smooths out your profit a little bit. It gives you more of a tax break when you're the most profitable and less of a tax break when you're the least profitable. So that would be the advantage to this units of production method. Questions or comments? Right then. Then we've got the double declining method. So this one is a little more complex. Definitely want to take some notes, or at least good mental notes here. This is the method where you don't factor in the salvage value at the beginning. In the other two, we had to take the original cost minus the salvage value to get our depreciable base, right? And then you either divided that by the number of years or by how many units you expect to produce. In this case, we don't factor in the salvage value until the end of the process. What we do is we take the original cost, we multiply it by 2. Now this method is called the double declining balance. So that's where the 2 comes from this double. We multiply the original cost by 2, but then we divide by how many years we're expecting to use the asset. So it's times 2 divided by the number of years. In this example, this is still the printing press. Yeah, still the printing press, still the same original $58,000 cost. They're planning to use it for 5 years. So they take the original cost of $58,000, multiply it by 2 divided by 5 for 5 years. And 2 divided by 5, you could also look at as 40%, right? If you take 2 and you divide it by 5, it equals 40%. So you can look at it that way as well. We're taking the original cost, multiplying it by 40%, which means in year 1, we get a $23,200 depreciation expense. Much bigger than the $9,000 or so that we got with the other methods. We get a much bigger write-off for our taxes in year 1. So this double declining balance method gives you a much bigger expense in the first couple of years. And if that's what you're looking for, you want to try to decrease your tax liability for the first couple of years significantly, you would use this method. Now, it does get a little tricky. So let's just walk through this year by year and see how it works. With the double declining method, again, we start with the original cost, and the salvage value we don't even get to until the very end. Okay, so we take the original cost of the asset, times 2 divided by 5, which again is 40%, which means that we take $23,200 of depreciation expense in the first year. So how much depreciation have we accumulated? Well, since this is the first year, we accumulated $23,200 worth, right? We didn't have any previous depreciation. But then what we do is we subtract that amount to get the new book value. So we take the original cost minus the accumulated depreciation, gives us our new book value, $34,800. And then we basically repeat that process. The new book value, right? We take that 34,800, again, multiply by 2 divided by 5, or 40%. That comes out now to 13,920. We add this new depreciation to our accumulated depreciation, so we add it here, but we subtract that amount over here. Okay, this can get a little tricky, you gotta really pay attention. Whatever amount you calculate as your depreciation expense, you add it to your accumulated depreciation, you subtract it from your book value. That then becomes your new book value. You take that 20,880 times 40%, gives us this new amount. Again, we add it to accumulated depreciation, subtract it from book value. But then we're planning to depreciate this asset over 5 years, right? Look at what happens here. We were down to $12,528 of book value. If we took that number and we multiplied it by 40%, that would come out to like around $5,000. But remember, we want to have $10,000 of salvage value left over. We can't take $5,000 of depreciation, right? If we took the $12,528 and subtract 5,000, that would put us under that salvage value. So when you get to that point with the double declining method, all you do is just subtract whatever is the difference, 2,528 in this case, right? That is your final depreciation expense, so that you will have fully depreciated the depreciable base of that asset, and it leaves you with your salvage value. So in year 5, we're not taking any depreciation. We've already fully depreciated. So look at how, with this method, we get a $23,000 expense to reduce our taxes in year 1, about $14,000 in year 2, and then not so much in years 3 and 4. It gives us a much bigger tax savings in those first couple of years. If that's what we're after, then the double declining balance method would be the way to go. We will practice this one, so if you didn't quite get all the steps, we will be doing it in the exercise set, and you'll be doing a problem like this as well. Questions on the double declining method? Oh, we have an exercise right here. Okay.